Hello, it's Rhonda Thomas, and we're just about to do Managerial Accounting's Chapter 1 Intro and Basic Exercises. So I'll go ahead and share my screen. Okay, I'm going to help you do the intro problems most of the time. You may get to do one or two, and then I'll also help you do a good majority of the coursework. But like I said, I do want to leave a little bit of problems for you to try to work out on your own too. Okay. I also have some exhibits and tables. So Managerial's nickname used to be cost accounting, and it still is, but we called it cost accounting a lot of the time. So we're going to focus on a lot of information about costs, because that's how you can improve your revenue, by reducing your costs. Okay, that's one strategy. How are manufacturing companies and service companies alike? So if you wanted to watch the video, they both have labor, material, and overhead costs. And those are your product costs. You're going to find out direct materials, direct labor, manufacturer overhead. Costs associated with hospital caregivers providing care is similar to, so the caregivers are hands-on with the patients. So that would be direct labor costs. Make sure you pick the right letter. Don't pick A and that not be direct labor costs, okay? All right, number two, which is not a factory overhead cost. So let me show you how these get divided up. Okay, classifying. Okay, we have direct materials, direct labor, manufacturer overhead. Here's what a direct and an indirect, the definition, okay? Direct is traceable. Indirect is not usually traceable. Okay, so let me see what else I have here. Okay, all right, so the one that's not the factory is, because this says cost of heating and lighting in the factory, property taxes on the building and the land. All of this is in the factory, so that's good, but the only one that is something that's direct is the materials cost for the finished product. So I've got C for that one. So materials cost for the finished product right there. Okay. Why are factory manufacturing overhead costs greater for defense contractors than they are for computer manufacturers? Well, if you're going to build big pieces of equipment for defense, it's probably going to take a pretty good sized place. Requires a significant investment in facilities and tools. All right. All right, we're ready for tell me more. The management processes. So the 4 management processes, here they are. Strategic, measurement, evaluation, and control. So you got to find the right one. Mine was A. Which of the following is true about managerial accounting reports? Now remember, in managerial accounting, you aren't following GAAP, okay? Not following GAAP, and you pretty much work on whatever management is needing at the time. So let me show you. Here is a good table for looking at managerial versus okay, so let me move that over. So managerial versus financial. It doesn't want to come up. Okay. I'll bring this to the front if I can. Oh, nope. Okay. All right. So which of the following is true about managerial accounting? Managerial accounting reports. No, they're not both external. Managerial is mainly internal. No, they don't have to be prepared according to GAAP. That's financial accounting. Yes, they are prepared on an as-needed basis, and they're often looking into the future. So financial accounting tends to be historical, according to GAAP, and external users. So there's some differences here, but this is a nice table that tells you what the differences are in the book. Okay, so all right, let's keep going. I'll just put this back where I had it. Okay. Onward we go. So blank are identified with and can be traced to a cost object. Okay, so that would be direct costs. Okay, direct costs, you can directly trace it. Here it is. Here's a picture. At least I think so. Hang on, let me fix this. We'll put these over here. Tried to pull the ones from the chapter that we would be looking at. So here is direct and indirect costs of these guitars that we're putting together. Okay, so here it is. You can trace these directly to the product. These aren't traceable. So direct costs go in either direct materials or direct labor, and anything indirect goes in manufacturing overhead. Okay, so okay, we're looking for direct costs as number one. Okay, and then number two, blank cannot be identified with or traced to a cost object. This is indirect costs. So mine is C, indirect costs. And then we're going to also break up costs between product and period. Okay, so product and period costs. And I'll show you what these are. So there, I think I've got a sheet here that shows product costs. Here it is, product cost and period costs. So product costs are everything that's at the factory, direct materials, direct labor, manufacturing overhead, and then period costs are selling and admin. And this gets looked at on the income statement. Okay, so let's go to 5. Inventory that consists of the costs of the direct materials and indirect materials that have not yet entered the manufacturing process are known as. So now that we're in manufacturing, we want to, here's what it looked like from financial accounting. So just a second, let me make this smaller. Okay. I think so. All right. So back in financial accounting, we had one inventory account. Now we've got them spread out over 3. And this is the order that they go in. So the name of the account where inventory is held for materials is called materials or materials inventory. Okay, so that would be up here, materials inventory. Okay, inventory that consists of direct materials, direct labor, and manufacturing overhead for the products is the second asset, inventory asset. Okay, and then the third one, okay, the total cost of making products that are available during the period is called cost of goods manufactured. Okay, not cost of goods sold. Make sure you know that. Okay, cost of goods manufactured. Okay, and we have an example of putting one together in number 10 here. So bear with me a minute. We'll get through these pretty quick. Okay, now we're going to look at the three main management processes. Developing long-term objectives. Long-term always means strategic. Process in which the management takes action to encourage specific behaviors or outcome. That's control. And process by which managers monitor operations by comparing actuals and expected results. Expected results are also estimates, and that's through evaluation. So those are, here are three of the management processes. The only one they didn't test us on was measurement. Okay. Onward we go, number 7. All right, so now we're going to break these up into direct materials, direct labor, or overhead costs. So at least you know they are all product costs. Okay, they are all product costs. So we can look at this one and see. Okay, so paper. So if we're a magazine publisher, the paper is going to be direct materials. The wages of the ones operating the printing machines is direct labor. Maintenance, any kind of maintenance in on the printing machines, if it doesn't go in either of these, this is the default bucket. And then the glue to bind the magazines, manufacturing overhead. So once again, you'll have to be able to distinguish one product cost from another. Okay, so now let's divide them into what's called prime and conversion costs. Okay, so let me go over here and look. Here we are. I'm just going to bring this down here. All right, so prime is your direct and your direct, these two here. And conversion is direct and manufacturing, and direct labor is both. So paper used in the magazines, that's going to be prime. Wages is going to be in both groups. Maintenance on the printing machines and the glue. Conversion. Okay, so once again, direct labor is both. Okay, now we're going to divide them up into product and period costs. Okay, so here is a pretty good picture. Okay, so let me get some more of these out of the way. We need these here pretty soon. Okay, so for period and product costs, so if it's a direct materials, direct labor, manufacturer overhead, anything at the factory or the plant, that's going to be a product cost. Okay, so let me scoot this back over now. Okay, so salaries, sales salaries, selling and admin fall under the category of period costs, which end up on the income statement. Okay, cost of goods sold ends up on the income statement too, but it starts with the balance sheet on inventory. Okay, so sales salary is going to be a selling expense, so it's period. Paper used in magazines, it's a direct material. Product cost. Depreciation for the headquarters. There's the key word for that one. That is period cost. Maintenance on printing machines. That's manufacturing overhead, and it's like one of the three product costs. Okay. Okay, now we're ready to put together a statement of cost of goods manufactured. So I want to show this to you. We're going to use this as an example. Okay, so I put follow chapter example. So it's a matter of getting a cost of goods manufactured in front of your face, right? So at the very top, they start with work in process. Work in process is, and I'm also going to do this in T accounts. Okay, so if you'll bear with me just a minute, I will take care of this. Okay, before you put this together, like I said, go get a picture of one. So work in process, cost of direct materials used in production, direct labor, manufacturing overhead. So I made a T account for our work in process. Okay, so it started with a beginning balance. So these are balance sheet accounts. This one, this one, this one. These are our inventory balance sheet accounts. Okay, so we start with the beginning balance of 49,000. Direct materials is 59,000. Direct labor is 74,000. Overhead is 36,000. And then that adds up for the month. Okay, so this is the month of June. I forgot to put that down. Okay, it is June. All right, so then it says total manufacturing cost. That's what this total is. This is just a subtotal for the period of time. Okay, so I'm going to put P for period. Okay, so we figured these three here is 169,000, and then you add the work in process in the beginning that was sitting there from the month before, and then you add it to the total manufacturing cost to get 218,000. Then you're going to subtract the ending balance of 41,000 to find this number here. This is the number that we're looking for. This is the name of the statement. Statement of cost of goods manufactured. And that has an abbreviation of cost of goods manufactured. And that's going out of work in process and in to finished goods, if we were going to do a journal entry. So now we're going to get ready to do an evaluation of the cost of goods sold. Now here is the cost of goods sold, but the cost of goods sold gets reported on the income statement. Okay, on the income statement. So it doesn't have a beginning and an ending balance, usually not. Okay, so when you do a statement of cost of goods sold, you basically are evaluating this account here. So it has a beginning balance of, from the month before, of 23,000. Okay, and then the cost of goods manufactured is 177,000. Then we have an available total that we could sell. So I'll put an asterisk for a subtotal and A for available. Okay, so we add these two together. Okay, and we have 200,000 as the cost of finished goods available for sale. And then down here, we have an ending balance as well. So a lot of these things, you just have to plug in the information they give you. They have to give you enough information for you to solve what they're wanting. Okay, it says that here, and here are our totals, right? Here's finished goods June 1, finished goods June 30th. So 17,000. Okay. All right, and then we're going to subtract. So I went ahead and put a negative in there. If they let you put a negative, go ahead and do it. If it shows it's wrong, you might try it as a positive number before you start trying to figure out a different number. All right. So what this does is this says that here are the goods that were sold, right? they come out of finished goods, and it is 183,000. Okay. When it comes out, it goes in cost of goods sold down here. Yep. So that's evaluating it. It leaves the balance sheet and goes to the income statement. Okay. And I went ahead and here's the little part of cost of goods sold. Okay. Okay. Let me go ahead and finish the rest of this now. We have one more to do and we are done with our intro problems. Okay, so this next one is evaluating some data. Okay, we are a small motel chain with locations near the national parks of Utah, Wyoming, and Montana. The chain has a total of 500 guest rooms. Okay. The following operating data are available for the month of June. So I'm going to put June down. Okay, so we need to know some of the statistics about this motel. Okay, so first question is determine the guest nights for June. So here's the guest nights. So I added up all of these right here, and I got $13,500. Okay, determine the available room nights for June. Well, here's the available rooms, and there are 30 days in June. So I put that there. So 15,000 is the available room nights for that particular motel. That's called capacity too. 15,000 rooms is the capacity for June. That's how many they could have rented out. So what's going on right now in this month for its occupancy rate? How do you find it? You take the number of guest nights and divide by the available rooms, and you're seeing that they're operating at 90%, okay, occupancy rate. And all right, so if you're renting out 90% of your available, you could do better. Okay, but if you ever get to 100% occupancy rate, you can't rent out any others, and you may need to decide if you need to grow or add on or what's going on there. So let's think about the year before. Assuming the occupancy rate for June of the prior year was 87% occupied. This year it's 90%. So yeah, that's an improvement. That's up 3%. It sure is. Okay, so that is it. Let me double check my work now. Okay, that is it for these problems. I appreciate you working them, and I will see you on the next video. Have a good one.